Pasricha is the Chief Economic Advisor, Union Bank of India, now joining in. Thanks so much for taking time out and just talking about the kind of pinch that we've been feeling on the inflation front, with the food prices in particular having galloped quite significantly. How much of a concern do you think that this is at a time that when we're looking at retail inflation back to the 2023 levels?
So, I would actually agree with what Nikun said. It's partly cyclical, though not all of it. But, if you actually just look at this, delve into details, first and foremost, we were at 6.15, number came in at 6.21. So, this was not a surprise to us. And CPI ex vegetables, it edged up to 3.6, 3.65%. So, that remains at comfortable levels, which is why that's the cyclical part of the story. The only concern which we think that the MPC may have at the current juncture is there are still some components which remain a slight pain point, and particularly it's for cereals, which saw 0.9% month-on-month jump, 10% weight in CPI, consistent upward pressure. So the good news is this time it was not because of on-the-ground prices rising, because when we speak to rice traders, the sowing has been good. Then we have actually seen fall in cereal prices on the ground, but the PDS prices suddenly have seen a sharp spike. So it was 21% month on month September, another 5%, 4.5%, 5% for rice this month. So I would just say that there are some underlying food components which may concern the RBI, like the edible oils 20% import duty hike leads to a threshold shift in inflation. It was a 25 basis points incremental contribution to inflation. So partly cyclical. Now, just a second point on how does MPC's projections pan out. So for this quarter, December quarter, they're at 4.8. They may actually see a number above 5.5%. But by the last quarter, only with vegetable inflation correcting from 42% to maybe nearing close to zero, the seasonal correction when it happens, you will see CPI correcting from 5.5 plus to 4.2%, which is aligned with MPC's forecast. So we do see inflation pressures normalizing by the last quarter. As of now, maintaining our rate cut call starting from February. But, as you were all discussing before this show, that in a volatile world, just having so many geopolitical tensions, so much uncertainty, later rather than sooner will be the theme for rate cuts this year. Thanks.
Exactly the point, Kanika, because this inflation figure, which is a little beyond RBI's comfort level as well, and at the upper end of the band, will definitely sort of alter RBI's policy path now. And one is wondering as to how much of a pushback would the rate cuts get now? What is it that you're penciling in?
So see, in our published forecast, we are maintaining our call of shallow 50 basis points rate cut, divided between February and April next year. But see, what happens is from a monetary policy reaction function, even though inflation may normalize, from growth perspective, the rationale for rate cut arises. And as you were discussing, while second quarter likely to be a weak growth quarter, from the third quarter onwards, with the green shoots arising from, say, government spending, rural demand recovery, auto sales, and other factors, we actually see the growth switching back to 7% handle in December and March quarter. So that rationale for rate cuts also needs to be watched out for if growth normalizes. And as I said, more importantly, if rupee keeps clocking record lows in every session, and we are in for a consistent uptrend in dollar with Trump coming back in the US, then the space for rate cuts also comes down. So, of course, risk for further deferment of our call, which is from Feb. Thanks.
Really appreciate your time and thank you for joining us. I'm just going to go back to Mark.